Michael Gapen, head of U.S. economics at Bank of America Global Research. The market is now seemingly free to treat good economic news as kind of good news, it seems, because inflation seems like it's on a good path, and the Fed told us what the Fed told us yesterday. What was your takeaway?
Yeah, I would agree with that now they're much more comfortable with the idea that we don't need a tremendous amount of labor market pain or demand destruction in order to bring inflation down. So on the margin, good news is still good news. So you would need to somehow see it feed back into higher inflation prints and resurging inflation to change that view. And I'd say the bulk of the data doesn't suggest that's very likely.
How have you adjusted your view of what rates are going to do next year, what the Fed is likely to do to rates?
So I would say yesterday brought kind of everything around to what we were thinking. Yeah. We were looking for a very dovish pivot. We were expecting kind of opening the door to having an easing bias over time, and we got that. So I'd say that the Fed kind of moved to where we were, and if anything, I think what you heard yesterday is they may be willing to get started sooner than later.
And sooner is, do you think first quarter makes sense? Or are they going to try and wait as long as it seems plausible to do so?
Yeah, at the moment, we think that they start in June. But yeah. I think yesterday you heard, should the data support starting earlier? Maybe inflation comes off more quickly or we get some economic weakness they don't expect, then I think March could be on the table, yes.
And in what kind of economy are they going to be doing that at this point? Are we really going to slow down? These numbers don't seem like we're that close to any landing.
They don't. And as Steve mentioned, our retail sales data, our card data supported a very strong number today. This is not a surprise to us. And what the tea leaves we've been reading suggests the consumer is still on solid footing. So the slowdown's likely to come in the non-consumer segments, business spending, maybe a bit of a fiscal policy drag. But altogether, it's an outlook where growth should hang in there, and a soft landing seems more likely than it was just 6 to 9 months ago.
Yeah, who's that, Steve?
Mike, I think that there's a great question now, which is not to take away from the euphoria around the Fed cutting rates. Is maybe you had expected a decline in business spending, but now that you have rates coming down, what about the impact of financial conditions? Two things are out there. Greg Yip had a very interesting article that the Fed is now underwriting the recovery, such that maybe the slowdown that had been predicted won't happen. Did Powell do too much in terms of going to the other side and actually easing financial conditions too much for what he wants to happen to inflation, such that is good news maybe, or too much good news, could that be bad news?
I mean, it's possible. I would say right now, financial conditions are probably still tight on net. They're just a lot less tighter than they were coming out of the November meeting. So they're tighter than they were, say, last March, April, or May. So I wouldn't go quite so far as to say they let too much of the cat out of the bag and maybe inflation could reaccelerate. But you make a good point, right? It's not when the Fed starts to ease. It's the market being forward-looking. Financial conditions are responding in advance of what the Fed may validate later. And so, therefore, maybe in the second half of 2024, what could be a weak business spending environment now turns into a more favorable one. That's certainly something we'll have to keep an eye out for.
Rick, you mentioned the sort of asymmetric reaction function of the Fed as they lay it out there, where they might be quicker to ease in the face of easing inflation than they were to do the opposite back when inflation was too low. Now, the market now is going farther still, and I know that you always like to contextualize what exactly the Fed funds futures are and are not implying, when we do get these big swings.
You can only really look towards the next meeting, maybe a little bit beyond that. But when you start trying to price in what's going to occur in May, or what's going to occur in the June 12th meeting, or the September 18th meeting next year, or even at the end of July meeting, you're really moving out too far. What we should really learn from Fed fund futures is that the markets are sort of like children. You give them one piece of candy, they want 5 pieces of candy. Fed fund futures have now erred on taking the unofficial stance of the Federal Reserve, and the unofficial stance is that they're done and eases are coming, and they're going to run with it and take it a little bit farther. So that's the dynamic to pay attention to. Believe me, if 1 month from now we get new inflation data that reheats, you're going to see the markets react very significantly in Fed fund futures from the front, and then it log jams all the way down. So that is the nervousness about a market that's trying to price these meetings where every month has a contract that affects the next month. So one thing changes, everything changes. It's like parallax. If you have a laser aimed at the moon and somebody just nudges it or sneezes in the room, it moves a lot. And that's what you need to worry about when you tie your fate to Fed fund futures contracts way down the road.
Yeah, as I mentioned earlier, I mean, back in the spring, they were projecting cuts by the end of this year. So it is pretty sensitive to changes. What concerns you, if anything, about next year in terms of the economic outlook, Michael? I mean, we have oil prices have been really cooperative. Almost everything has moved in the right direction, frankly.
Yeah, literally since late October, early November, everything's moved in a very favorable direction for the soft landing camp and the Fed's outlook. I would say maybe what's concerning is that rarely happens and that rarely continues in a straight line fashion. And I do think we need to be, worried about the first half of the year, and maybe the labor market does soften too much. But from a policymaker perspective, what to do in that situation is clear. How the markets can trade that would be quite clear. So I would say in the first half of the year, we're kind of watching for lagged effects of fiscal policy and slowdowns in business spending and fiscal drag. And that's kind of where the negative could come in. But as you mentioned, virtually all the data has been very conducive to a soft landing.